Imagine you're playing basketball. The player dribbles up the court, plants one foot, pivots, and changes direction. That single point, the pivot point, is where everything shifts. In trading, pivot points work exactly the same way. They show you where the market could turn, pause, or accelerate. Pivot points are one of the oldest and most reliable technical tools in trading. They were first used by floor traders before computers because they needed quick ways to calculate potential support and resistance levels for the day. Even now, decades later, professional traders still use them because they map out where price is likely to react. So, what exactly is a pivot point? In simple terms, the pivot point, P, is the average of the previous day's high, low, and close. From that central pivot, a series of support S1, S2, or S3 and resistance are 1, 2, and 3 levels are calculated standard formulas based on the same data. It's like drawing a map for the next trading day, showing where price might stall, bounce, or break through. If you think about it, traders from all over the world calculate these same levels. So when price approach a pivot, everyone is watching. That's why they often work so well. They become self-fulfilling levels of reaction. So how to read the pivot points? Here is the logic. When price is above the central pivot P, the sentiment is bullish. Buyers are in control. When price is below the pivot, sentiment is bearish. Sellers are leading. The R levels R1, 2, and 3 act as potential resistance zones, while the S level S1, S2, or S3 act as support zones. Think of this as the floor and ceiling of the day's price action. The pivot point is the balance point in the middle, the place where sentiment can shift either way. Let's say yesterday's high was 1.1050 and low was 1.0950 and the close was 1.1000. So, P equals 1.1050 plus 1.0950 plus the 1.1000, and that we divide by 3, and that equals 1.1000. Using that pivot, your chart for today might show resistance 1 at 1.1050, support 1 at 1.0950, resistance 2 at 1.1100, support 2 at 1.0900. If price opens above 1.1000 and keeps pushing towards R1, you know buyers are strong. But if it opens below and drops toward S1, sellers are taking over. This is why the pivot points are so powerful for day traders. They offer a clear roadmap for a trading session using just one simple calculation. Over time, traders developed several variations. The first one, the standard classic, the original version we just described. The second, the Fibonacci pivot points, use Fibonacci ratios to project support and resistance. The third one, the Camarilla pivot points, tire levels often used for mean reversions and scalping. The fourth one is the Woody's pivot point, give more weight to the closing price, making them more reactive. Each version serves a slightly different purpose, but the logic is always the same: identifying key zones where the markets could bounce or break. So let's see how traders use the pivot points. There are three main strategies. The first one is the bounce strategy. When price approaches a pivot level, S1 or R1, traders wait for a rejection pattern, such as a pin bar or engulfing candle to confirm a bounce. This works best in range-bound markets where price oscillates between support and resistance. The second is the breakout strategy. When price breaks through a pivot level with strong volume, it often continues towards the next one. This strategy is ideal for trending days. For example, price breaks above resistance 1 with momentum. Next target is resistance 2. Breaks below support 1, next stop is support 2. The third one is the sentiment filter. Some traders use the central pivot as a sentiment line. Only take long trades if price is above it. Only take shorts if price is below it. This simple rule helps keep you trading in sync with the market's direction. Pivot points become even more powerful when you combine them with other indicators. With RSI or stochastic, you can confirm if price near a pivot is also overbought or oversold. With the VWAP, you can see if institutional traders are defending the same levels. With moving average, you can identify when trend and pivot confluence aligns. Here's a simple day trading setup. The first one, wait for the market to open and stabilize. The second, mark the pivot, S1 and R1 on your chart. The third, identify whether price is above or below the pivot. The fourth, trade toward the next pivot level in the direction of the trend, using a stop just beyond the previous level. Let's think of pivot points in a metaphorical way. Imagine you're hiking a mountain. Every pivot level is like a rest stop or checkpoint along the trail. You don't jump straight to the peak, you move from one level to the next. Sometimes you rest, sometimes you fall back, sometimes you push through to the next stages. That's exactly how price moves. It climbs or falls through these levels, pausing or reversing along the way. Let's recap what you've just learned. Pivot points are calculated from the previous day's high, low, and close. They create predictable support and resistance zones. Above P equals bullish, below P equals bearish. The R levels equals resistance. The S level equals support, used for bounce breakouts and sentiment strategies. Work best when confirmed with volume or momentum indicators. In short, the pivot points are your daily map of market structure. They don't predict the future, but they show you where traders are most likely to act. So remember, every trading day starts with a pivot. It's the moment the market decides. Will it move up, down, or just hold its ground? And knowing where those turning points are gives you a powerful head start.